There's a whole bunch of pent up demand that isn't eliminated from this market. It's just waiting to figure out what interest rates are going to do. And once they start to tick down, it's going to be the same wave that we had earlier of buyers coming into the market. It's going to be competitive again, and it's going to be hard to get into a home. But now there are fewer buyers. We have strength in this market as a buyer and more options. So you just have to look at the whole picture, and if the timing makes sense for you to do it now's a good time to sell and buy and stay in Austin's market. I wouldn't want to take my money out of Austin's market long term, though.
The Real Estate Wise Guys Podcast.
What is up, my friends? Welcome to the third episode of the Real Estate Wise Guys. I am Zach Barger, and this is my lovely co-host, Sean Weiss. How are we doing today, Sean?
I'm doing fantastic. How are you?
It's living the dream. How's the real estate biz treating you these days?
It's we're in a different time, so we're experiencing some different things. How about you?
I mean, I've been negotiating over the loudest toilet I've ever heard in my life this week on a deal.
Loud? The loudest toilet?
It literally sounded like there was a jet inside of this toilet. And the sellers are refusing to replace it because it still works. But
technicality.
Hey, we are getting to the finish line on this deal, but it has been a fun negotiation period for this deal.
There's some that are more fun than others.
Yeah, indeed. All right. Well, today we have a bunch of listener questions that we're going to jump into. Shall we just get started on that?
Yeah, I'll start with the first one. This is from Lindsay, and she said, I see that prices are reducing. What's my best play if I want to sell my house?
All right. John, are prices reducing?
Prices are not reducing. By the standard and the metrics that we look at year over year, which the numbers for September that came out last week, we saw a increase in the year-over-year median sales price. It's at $555,000. We have yet to see a decline year-over-year. What she may be referring to is we're seeing a seasonality decline. So, April, May, when prices were kind of at their peak, and we have trended down on a monthly basis. But if you look at historical numbers, that's true every year. The bell curve is a little bit steeper some years than others. The top of that bell curve is a little bit wider than other years. But right now, obviously, we are seeing more of a dramatic fall on that. But we are still above last year's prices as of right now. And the overall sentiment is we are going to probably finish the year at a positive. So, there's a chance like maybe towards December we may get less appreciation year over year, but unlikely to go flat or even zero in 2022. The beginning of next year, if prices continue to slip, then we may see that decline, but we have yet to see that. What people are kind of probably hearing is prices have fallen from April. We're seeing price reductions, that sort of thing. But the actual sales that are taking place, homes that are selling now are selling at a higher price than they were a year ago. So that's the first thing to kind of get that out of the way. But she is making the point that it is certainly harder to sell a home right now.
Most definitely. Yep. And the other aspect of that is does that mean that I think part of the theme of the question there, or the thought process behind the question, is are we going to see prices continue to drop even though they haven't actually dropped? But there's a sentiment out there that prices are going to go down. So should I sell my house now to make sure that I'm not losing money? I personally feel that in most cases in Austin and the surrounding areas, 6 months from now, you might not have a big gain on your house. It might go down a little bit, but the reality is it's probably going to stay pretty level with the chance of going slightly up or slightly down. But long term, Austin and Austin surrounding markets, it's a good place to be a homeowner. It's going to be a good investment long term. So just to kind of clarify on when she's asking about prices reducing, they might go down a little bit, but they also might go up a little bit. They're not going to drop. We're not going to have an 08, 09 type scenario where it's a drastic drop that we saw in that time frame.
Right. Yeah. Even the most, I would say, negative outlooks by experts in the field, their price decline is definitely less than 10%. And then the optimistic outlook is obviously that we are unlikely to see 5 or 6% next year. It's probably going to be below 5% year over year appreciation. But again, when we're looking month to month, like homes were more expensive in April than they are right now, for sure.
Right.
But are they going to be cheaper next April than they were this April? No one really knows that yet. There's a good chance that they're going to be less, but it's going to be, a more modest amount, likely less than 5% decline if we do see that. Every month is kind of surprising people. People expected prices to fall further than we have so far, and that's just a testament to there's still a lot of demand out there, and we don't actually have a ton of inventory. Relatively speaking, we are at higher levels than we've been, but that's coming from historically very, very low levels.
For sure. Yeah. So the aspect of this, when we're talking about actually selling the house in this market, it is a very different scenario than it was 6 months ago and definitely a year ago as far as selling a house in this market. There are steps that we need to take to ensure that we put you in a position to have success. The most important aspect of that is
Price.
price. It is most definitely price. Positioning your home properly in the market is key. Now, Sean, you want to walk us through what that looks like? Are we just looking at sold comps, or are there other aspects that we're going to look at when we're talking about how to position a home?
Yeah, so we've pretty much shifted our kind of formula or our due diligence when pricing a listing from historically, you'd always look at sold comps, and ideally you don't go back super far, but 6 months was very common. Sometimes you'd need to go back 12 months in the past to get enough data points to help kind of build your new list price. Obviously, the more similar the home is and the more recent the sale was, the more weight that you would give that specific comp. Now, because we've had so much movement over the last 6 to 9 months, we aren't going back that far. And to be honest, we're not going much further than 30 days. We're going to look at the last few comps that have sold, maybe one or two. And then what we're really going to look at is what's under contract, what's pending, and then what's active. Because what wasn't happening these last few years, and it was happening in 19, but on a we were kind of on the upswing in that market. Now we're kind of moving down, is the active comps matter because that's your competition. So if you go and price your home and you are above a handful of active comps in the neighborhood, then you're likely going to sit on the market. You need to kind of undercut your competition either by price, or you need to be a better product, meaning it needs to be more updated, nicer, better presentation, that sort of thing. The pricing of that active comps is what we are putting a ton of emphasis on. Who's our competition? How long have they been on the market? The stuff that is going under contract, where they position in the market. And a lot of times it's not a surprise, but the ones that are going under contract are a combination of they're the nicer ones in the neighborhood, and they're the most aggressively priced.
Right, for sure. I mean, you definitely don't want to overcomplicate this. This is a pretty simple concept. We want to make sure that when buyers are looking at houses in the area in our price point, that our listing pops up as the most attractive. And that's done through, one, the price point, and two, presentation. Yeah. When we're listing that home, things that we're going to help you through and guide you through are staging that home, getting professional photos taken of that home to ensure that online it's going to be seen as well as it can possibly be seen. It's going to be as attractive as it can possibly be, which will then lead to more showings. More showings lead to more offers. And in this market, gives you a better shot at getting your house under contract quickly and at the highest dollar amount. What we don't want to do is overprice the home. Can you jump into some of the reasons why overpricing can be such a negative, especially in a market like this?
Yeah, so overpricing is much easier to do now than what it's been the last few years. Sure. It was pretty hard to overprice a home these last few years. So now by doing that, you pretty much, the market's going to immediately respond to you and your price, and they're not going to look at it. And maybe you will get showings, but you're not going to get any offers. So likely what happens is you spend days on the market, weeks on the market, maybe a month, and then you do a price reduction. And now you are chasing buyers that may have been interested otherwise, but you almost have to overcorrect on your price. Right. So a lot of times with a price reduction comes the sentiment of what's wrong or why are they reducing their price, and it adds questions or doubt from a buyer's perspective. You end up with more days on market even if you do a price reduction trying for that higher price. And in this market, that is detrimental to the sales process. Before, even in 2017, 2018, 2019, you could almost, you could correct that mistake because the way the market was moving and kind of how it was operating. Right now, because higher interest rates, there's just, buyer sentiment is somewhat fearful or hesitant. You can't really afford to overprice and then try to correct it because you'll end up, you're going to chase them too far down and then you're going to be unhappy with the price. So pricing correctly out of the gate is super important. One other thing that I wanted to touch on presentation, and this kind of can segue into one of our other questions if you don't have anything else to add, is not only presentation with staging and, dressing up the yard and professional photos, but actually making some updates to the home prior to that. Before, again, these last few years and even pre-2020, updates mattered, it was just your standard stuff of, what made sense to update to appeal to more buyers. Right now, a way to stand out when you are pricing your home, and if you're in the thick of, you've got 6 or 7 active comps that you're competing against and you're in the thick of it on price, the way to stand out is to be a more updated home, higher end finish outs, or just, less dated, and just little stuff. I mean, even just replacing a front door or repainting, or landscaping is a big one. That curb appeal when you walk into the house, if you can set yourself apart with that, whether you're going to spend a few $1,000s or $20,000 to make those upgrades, you will make a big difference when you actually go to market if you're competing with homes that, say, are a little bit more dated.
For sure. The aspects that are going to show up in that highlight reel being the photos that are going to show up online, because that's where our buyers are first going to see the home. We want to make sure that those highlight videos, those highlight photos look as good as possible. So that's why curb appeal can be such a huge difference, like the front door. Nar always talks about that being the best bang for your buck when it comes to
best ROI is replacing your front door.
Indeed, which is, we talk about this, we're not real sure how they find that number, but it is definitely something that can improve the curb appeal. And generally speaking, that's going to be your first photo online. And if that doesn't look appealing and people just move on to the next one, that's a buyer that could have been interested in your home that just moved on. It's very important that presentation, we do everything we can to make sure your home is seen in the best light possible.
Absolutely. And the other question that we got was from Kyle, and his question was, what is the best bang for your buck on house projects for resale value, which is kind of what we were talking about. When listing a home, there's certain things that you want to do. Landscaping is something that I recommend to every seller, just cleaning it up, dressing it up, adding, whether it's remulching or gravel, new plants, getting the grass in better shape. All of those things are going to be helpful. On the house projects for resale value, what can I do in the home that's going to add value when I go sell eventually?
Right. Kyle and Ellie are planning on living in the home for a while, so they're wanting to do upgrades now, but long term, they want to make sure that it pays off.
Yeah, spend smart money. So the two biggest ones and most obvious and kind of common ones are kitchens and primary bathrooms. Those are the two number one things that buyers are attracted to, and will kind of push them over the edge when comparing two homes, mainly because that's where they spend, the majority of their time in the home. The kitchens are huge. It's a lot of times it's a space that you can see from multiple places with, from the home, living room, dining room, you're spending time in the kitchen. So spending money in the kitchen does go a long way. And you can spend a lot of money in the kitchen. You can kind of do it in different phases. It can be updating the appliances. It can be updating, countertops, cabinet poles, paint color, light fixtures, any of those things. You don't have to gut the whole kitchen and completely redo it. You can just make some cosmetic updates to set that apart. And then the primary bathroom is kind of the same, flooring, tile, shower, fixtures in there, same thing. You can, if you're spending the money there, there's certainly an ROI on that with buyers. And sometimes to be honest, it's hard to quantify what that dollar return is, but it is very apparent when you look at the homes that are selling. And this was in the peak crazy 2021, and also, what we're seeing now as well as 2018. The homes that have updated, nice kitchens and primary bathrooms are the ones that are either consistently selling quicker and for higher dollars.
Without a doubt, for sure. If the homes, if they're not priced appropriately, that are dated and have kitchens that need work, or the whole house needs work, if you aren't significantly cheaper than the other houses in the neighborhood, and when we're looking at the competition, it's not going to sell. Again, when most people are looking at houses online, and if it's within their price point, they're going to go for something that pops off the page in the pictures when it comes to the kitchen, the front, curb appeal, all that good stuff. So the kitchen, primary bathrooms, those are the biggest ones that are eye catchers when looking through an online portal and looking at houses, and then that translates to it showing better as well.
Yeah, absolutely. Anna's question is, what are some medium to short-term rental websites for travel nurses? So this is something specifically asking about travel nurses, which is something that's very popular right now because of the nurse shortage around the country. We're seeing that. We've seen that firsthand with some of our clients. But Zach, I know you've done some research on this. So yeah, can you talk about some of the options for how to secure those types of tenants?
For sure. I'm actually looking to do this personally. Closed on a house with some partners last week in Kyle, and actually purchasing one more in Kyle next week. And we're going to try to, for both of these homes, rent them out to as a medium-term rental. The ideal target audience are nurses, are travel nurses, just because there's a lot of them, a lot of hospitals in that area. There's a lot of travel nurses that are being moved there, and we can get a slightly higher rate with the furnished home and a shorter lease term. Some of the pros with that is we're going to get a higher rent rate, right? If we're doing a 30-day or somewhere between 30 and 90 days. The other component is in most cases, different city regulations, you don't need a permit for a 30-day or longer lease, so you don't have to mess with any of the permitting, especially in City of Austin. So that's a big win. And most HOAs aren't going to have restrictions that are going to be less than 30 days or for 30 days or longer. Some will. There's some that have like a minimum lease term of 90 days, but for the most part, you'll be able to avoid issues with HOAs when it comes to the medium-term rentals. The other aspect, the kind of a con of this is you are going to have to furnish the home, right? So you're going to have to spend a little bit more money to furnish the home. But at the end of the day, on the ROI, most of the time you're going to make a higher cash flow number, a significantly higher cash flow number when it's all said and done by doing a medium-term rental in comparison to a standard long-term rental. As far as where to find these tenants, and in particular travel nurses, in the research that I've done so far in this process, the best resources that I've found have been travelnursehousing.com and furnishedfinder.com. And I've spoken to a couple nurses that I know as well, and they've reinforced that when the travel nurses move in, they are looking, generally speaking, on Furnished Finder as well as on Facebook Marketplace for these short-term rentals or mid-term rental options. Definitely a great thing to look at, though, as an investor. If you have a rental property right now that is you have set up as a long-term, you might want to look at it being a medium-term rental, see if you can increase that cash flow number, if it can increase your ROI overall on the property. Obviously, there's a little bit more work that goes into having to change over tenants throughout the year, but it can definitely pay for itself by getting that higher interest or that higher rent rate. Sorry.
One thing I want to add on that, and Zach touched on it, short-term rentals, obviously very popular. The Airbnb, Verbo type of product is short-term is technically classified, at least on the City of Austin definition, is 30 days or less. So if you are securing a tenant for 31 days or longer, which these travel nurses, a lot of times it's actually weeks. So they do like 8-week contracts or 12-week contracts, something like that. So 2 to 3 months. And a lot of those, they re-up at least once, at least from my experience of the client that I've worked with on it. So if you're doing at least 30 days or 31 days, then you don't have to abide by all the, rules and regulations that the City of Austin has on short-term rentals. You don't need a permit. You're not paying hotel occupancy tax. You kind of skirt all that stuff. So that's why, that's a big appeal, because you're not having to kind of play that game. And it's hard to get a short-term rental permit. You can get denied pretty easily. A lot of neighborhoods have restrictions. And one thing that Zach mentioned too, HOAs are most likely going to be your biggest issue when working through that. So just read those HOA docs. I know Zach said some of them have 90 days. I see 6 months a lot as well. So that's just something to be aware of, pay attention to, at least find out about it ahead of time. And if you end up having to do kind of 6-month terms, that's also an option, even if it is a kind of a furnished rental. But what you don't want to do is furnish the place and get everything set up, and then the HOA shuts you down because you're doing, 60-day leases and they don't allow anything less than 6. So just do your research on that and make sure if you're not an HOA, then you're really just beholden to the city regulations, which for the Austin and surrounding areas, 31 days or more, you would be in the clear on that.
For sure. Yeah, but definitely if you're looking at ways to get into investing and you're concerned about most of the places in Austin or surrounding areas, if you're just putting 20-25% down, you're not going to be able to cash flow on a property with a regular long-term lease. But this is a solution that can allow you to cash flow as well as be able to put yourself in a position to gain that equity that you're likely to get in Austin's market.
Yeah, and this is another play in a time where we're seeing higher interest rates. So obviously, if you're buying an investment property now versus 2 years ago, price is one factor, but the rate's higher. So your monthly payment's going to be, significantly higher than it was just a few years ago. So this is a way to kind of recapture some of that increase, carrying cost. Not to mention that long-term rental rates are going up significantly as well, and they will continue to do so because those numbers just get passed down to renters. So we're going to see quite a bit of rent growth, but the short-term furnished lease option is going to give you a better monthly rate. Obviously, a little bit more management, a little bit more hands-on than a long-term tenant, but good option for people that are looking for that monthly cash flow.
100%. All right, we'll move on to the next one. My friend Mick asks, big businesses like Zillow tried and failed with rental investments. How can mom and pop investors avoid those mistakes?
So this is an interesting one. And if you aren't familiar, Zillow and there's companies like Orchard and Open Door, there's a handful out there that they're referred to as iBuyers. They're basically large tech companies, institutional money that are buying investment properties in very large quantities. So Open Door was doing a lot of that in Austin through programs that they have of, they basically buy it from a seller, so that seller can then go buy another property, and then once that seller moves out, they turn around and sell it. So they are basically kind of the middleman. They don't intend to hold any of these properties long term. They're not acquiring them for rental. It's to make money basically on the transaction, help out the seller who's looking to move up and couldn't buy a new house without selling the first one. And there are a lot that there are other companies like homesforrent.com, which I think is the largest single family property owner in the country, and that is what they do. They buy homes, thousands and thousands of homes, and rent them out. It's the Zillow model was not, the intent was not to hold them long term, but they still got burned pretty good because they were buying properties basically on a short term basis, trying to turn around and sell them for, I would assume, a gain, but they were not even breaking even in a lot of cases. They were losing money, and a part of that is they were kind of overpaying on the front end, but they also were trying to negotiate these deals with sellers because that's the advantage. Say, you sell it to us, we're quick and easy, we can give you, we'll close cash in 10 days. So it's appealing to the seller, but sellers in Austin also were familiar with the market. They knew what stuff was going for, they knew what stuff was worth, so they were less likely to come off of, market value significantly. And Zillow's, was kind of got it stuck with overpaying, not even overpaying. They were probably paying under market a little bit, but it wasn't enough to where they turned around and tried to sell it and they weren't losing money. You can do your own research, but there's statistics out there on people that were tracking what Zillow and Open Door were buying homes for and then what they were selling them for. And I think it was like more than half of the homes they were selling for less than what they paid for them. And this is hundreds of millions of dollars, if not, billions of dollars in homes that they were doing this for. And it was,
I had multiple people during 2021 and the beginning of this year, 2022, where it was still the crazy competitive scenario that asked if they should look at a Zillow offer, and they show me what the number was on their house rather than selling it with me. And I told them, take it.
Yeah.
Because there's no way I can get you that number. There's multiple times that Zillow, like their algorithm, their process that they use was just so vague that they weren't actually looking at the properties and they were offering numbers.
And I actually had a client like that as well, where we ran comps, and I kind of, when I'm listing a property, I will give them the kind of the worst case, ideal, and kind of like that dream number, and give you the range of where we think we're going to land. And I think this one was Open Door, I don't remember, but they did the same thing. They got an offer from them, and it was like $25,000 over the dream number that I gave them, which in the market, I think we probably gotten pretty close to that, to the dream number, but certainly not what they ended up getting. And it was a, smooth, clean deal. And a lot of times there's a little bit of a bait and switch of they give them this offer online, then they come inspect the property and look at it, and then they take quite a bit off of that. But they went through that process and they didn't come off their number, and right. It seemed too good to be true, and my clients did pretty well with it.
For sure. On the flip side of that, one of the strategies that I was employing last year and then the beginning of this year was trying to find the resales of those Zillow and those Open Doors, because they did the exact opposite of what we were just describing as far as presenting the home and pricing it appropriately. They were pricing it way above market value because they purchased it for too high. And then after, 2 months of being on the market, when it was the only house on the market that didn't sell the first weekend, we were able to negotiate that price down. So I was able to help a few people get in to homes during that time frame that were sold by Zillow and Open Door, simply because they had positioned it so improperly out of the gates, and it wasn't a multiple offer situation, which back then was hard to come by.
Yeah, rare. And to kind of come back to the question of how to avoid some of those mistakes, the biggest one, in my opinion, and this is true even if you're an individual but a big time investor and you're investing in single family homes in multiple markets, the more broad that you are and the more properties that you have, you're likely to make some mistakes and misstep on valuations and that sort of thing. Residential real estate is hyper local. If you are investing in the city of Austin or the surrounding area, that would be a good focus, but is even kind of broad. I know investors that they will only buy property in one zip code or one neighborhood, and they focus on that because they know that neighborhood in and out. They know every single home that sells, what the finish outs in all those homes, like they get really dialed in on that specific neighborhood, and they're likely going to be much better at valuing those properties when they do come to the market and negotiating those things, because they're very familiar. And there's not very many that are that focused, but in general, residential real estate is very local. So when you are Zillow and you're buying in 28 different markets and deploying $1 billion to do so using an algorithm, you can have some rounding errors that are going to cost you a lot of money. And if when they weren't buying really expensive homes. They're buying homes between $300,000 and $500,000. So if they're off by 15, 20 grand, that's going to hurt them, and that's essentially what they're going to lose when they go to sell it in a market where most buyers are represented with a real estate agent who is a market expert in their area or the sub-market and can look at that and say, no, that's, I've ran the comps, these homes are very similar. They sold for X, Y, and Z, and that's overpriced by 25 grand. And you can use that. And when that's the case, it's just not going to sell, like in Zach's case. So then you have Zach bring his buyer there. They run the comps. They know what it's worth. They make an offer, and obviously Zillow they have the funds to lose a little bit of money. So they were selling them at a loss when they were trying to get out of certain markets. But I would say it's probably harder to make the same mistakes as Zillow as an individual investor than it is not to. If you're doing this on an individual level, you're going to have the counsel of your real estate agent who's going to be running comps, showing you data points in that specific neighborhood, showing you what it sold for the last time it sold, kind of the potential in the neighborhood, and you're much less likely to kind of overshoot by a number because you're not taking this broad brush approach. So definitely, that idea is not something that we see happen with individual investors. It's going to be more buy it right, and then your hold period is a big one. Zillow and Opendoor, they were holding these properties for a very short amount of time, which is obviously hard to navigate when you are trying to turn a profit on it.
For sure. The other aspect is they were only using the wholesale strategy, right? They were trying to purchase properties and then just flip them around and make the margin on what they thought they got the deal on with the initial purchase. And there was also a speculative component to that where they were anticipating home prices to continue to increase at a ridiculous rate, which we finally have seen slow down. So that was part of why they lost as well. So when you're working with us as agents and we're going through this process, we're looking at the investment strategy for you. We're looking at more than just a purchase price. We're looking at what your options are as far as what you're going to be able to rent it out for. We can look at the different renting options, right? We just talked about medium-term and short-term rentals as well as irregular long-term rentals. But we want to make sure that those numbers make sense and that we also have multiple exit plans. Like you just talked about your hold period. The reality is if you're going to buy something in Austin and you are in a position where you can hold it and handle some vacancy throughout that time frame for 5 years or so, you're going to have a really nice return on that property, regardless of when you purchase it. Whether you bought right at the top in 2022 in April or so, if you're holding that thing for 5 years, I don't see any scenario in which you don't have a really nice return for 5 years. So we want to make sure that you have short-term and long-term plans and goals with that property that give you flexibility to ensure that no matter what the market conditions are, that you're going to be able to at least have a close to a positive cash flow, maybe slightly under, but you're able to hold on to that property and get it to what you really want, which is a long-term gain.
Yeah, that's all good information. It looks like we got one or two more. I'm going to move on to Miranda. She said, I recently heard someone talk about Austin market being about the Austin market being as stratified. What does that mean? And is Austin a stratified market?
So I actually had to Google this one, and I'd never heard the term stratified market before. But the concept of a stratified market is it's neither a buyer or seller's market when we look at the whole thing. There's aspects of within that market that some areas are buyer's markets and some areas are seller's markets as far as, different neighborhoods and things along those lines. I think that's definitely the case in Austin. I think there's some areas that are seeing a little bit of price decrease, more so than other places. I think across the board, it's much more of a buyer's market than it has been for sure. It's definitely, I don't think there's an area in town where you would say, yeah, this is definitely a super hot seller's market. Right. But I think that there are some areas more than others that have seen a little bit of price depreciation. I think, for example, areas that were growing quickly, that there's a lot of land around them and not a lot of development, like some areas in Pflugerville, like the new communities that were selling at very high numbers. The resale on those has definitely been a lot less than what the initial purchase price was on a few of those if you buy within the last year or so. I think eventually that will come right back up and it's not going to be a huge loss. But when you're looking at places that don't have the type of density that you have like in Austin, like in the city of Austin, we're not really seeing price decreases at all. I mean, we know year over year, we've talked about this. We're at a 5% increase right now, and likely are going to have somewhere in that ballpark for our median home price for the whole year over year. But places that are more on the outskirts and are growing areas, and you just have these brand new developments that are surrounded by fields and not inside the city. Those ones we've seen a little bit more become much more of a buyer's market rather than a seller's market.
Yeah. And one thing that I'll add to that, the kind of move from a seller's market that we were in to a buyer's market that we're heading to. And this is kind of real estate agent speak or industry speak of months of inventory. And we've talked about how that's quantified. But the short answer is basically how many months would it take at the current buyer demand level to absorb the existing inventory. So when it's 2.5 months, that means if no new listings came on the market at the pace of which buyers are buying homes, it would take 2.5 months for everything to be purchased. Well, NAR, the National Association of Realtors, has a general statistic of 6 months of inventory is a balanced market. That's neither a buyer's market or a seller's market. A lot of people in the industry don't really agree with that number, but something that's more important now, what we're experiencing, we got down to below 1 month of inventory. We were, I think, 0.6 in the city of Austin, a half a month inventory at the lowest point, and now we're at 2.7. So we are kind of moving up in that direction. If 6 is the balanced market, we're kind of already feel like we're in a buyer's market. And the takeaway there is it's really when the transition happens. So we are going from a seller's market to a buyer's market. So it feels like a buyer's market all the way there. We don't have to wait to get to 6 to be like, okay, we're officially in a balanced market. And then 7 months of inventory is a buyer's market. As soon as you kind of bounce off that bottom and you're headed towards, 4 months of inventory or 5 months of inventory, that's really when the shift is happening. It is now a buyer's market. And then the same thing, if we get to 6 months of inventory and then it starts to come down, it's going to flip to a seller's market well before we're at 2 months of inventory. It's going to feel like a seller's market as we're kind of gobbling up that inventory on the way down. So right now, to Zach's point, it kind of depends on where you're at. If you're in the outskirts outside of the city of Austin, kind of on the periphery of the Kyle, Buda, Pflugerville, Manor, even like Hutto and Taylor, those areas, like those are going to be a little bit more volatile than, say, Central Austin is. When you're in Central Austin, there's not a whole lot of new development going on, certainly not, adding to the supply. So it's the price, decline or the price movement's going to be much slower, a little bit more lethargic than some of those other areas where you have either an influx in supply or just not a ton of demand in those areas. Central Austin or Austin in general, you're going to have higher levels of demand.
Most definitely. All right, we got one more question here. This is from Colby. Do you feel the market will rebound enough that it's more profitable to keep your home rather than sell your property? So,
short answer.
Yes.
Most
definitely.
If you keep it long enough, you'll never lose money. I mean, that's Warren Buffett says you only lose money when you sell. Yeah. So just don't sell it.
What does he know?
Yeah.
There's a whole bunch of layers that we can dive into with this question. First of all, a lot of it depends on what your goals are. Now, one of the aspects of Colby is a client of mine, so I know that she purchased her home 3 years ago and has a nice chunk of equity in that home. The tone of the question obviously makes it sound like we're concerned about should I sell so I don't lose money because prices are going to go down. I think we've talked about that enough.
Yeah, which is a fair question, and that the short answer is it's too hard to time the market. No one really knows if you sell your house today, are you going to get a higher price than you will in December? Are you going to get a higher price today than you would in February or next April? No one really knows. We can kind of crunch those numbers, but real estate is kind of hard to predict on such a short-term basis. The question would be if you sell this October or this November versus next November versus November of 2024, it's much easier to say like there's a good chance, that you will continue to see equity growth next year. Probably going to be based on, a lot of people's opinion, it's going to be relatively flat. So maybe you sell it for the same price next November as you would this November and you own it for a whole extra year. So it would make sense to sell this year and take that money elsewhere or whatever. But if you are not motivated to sell right now and you have the ability to hold it, whether you're occupying it or renting it out, then like Zach said earlier, if you own this home 3 or 4 years from now, then yeah, you're likely definitely going to have more equity than you will today.
And the answer to questions like this always is it depends, right? It depends on what your goals are. Now, what you're going to do with this money is a huge aspect of whether or not it makes sense to sell this house. So if we're looking at using those funds and just putting it in a savings account, definitely don't sell your home. Like hold on to that money. If a goal of yours is to get into a different area of town, into a higher price point, and you want to use these funds to move into a different area of town, that's something we can look at, but you have to be willing to take on a much bigger payment. Because I know in Colby's scenario, and a ton of people in Austin are in the same scenario, they bought in 2017, 2018, 2019. They have a ton of equity in their house, but they have a really low interest rate right now, and their payment is attractive. It's a payment that's just not achievable in today's market. So if you want to make that move, this is definitely a great time to do it, because it's not going to get cheaper long term, right? Like maybe over the next month or so, it might be a little lower than it is right now, but it's not going to be a substantial decrease, but you'll be paying a much higher rate and your payment will jump up significantly. So if you're willing to take on that bigger payment, now is a good time to make that move up. You just have to be willing to handle that larger additional monthly payment. Do you have anything to add on that concept?
Yeah, the interest rates thing is obviously probably the thing that's dominating the news cycle, and also it's what's affecting our industry more than anything else right now. I mean, buyer demand is down specifically because interest rates have moved up so quickly in such a short amount, or so much in such a short amount of time. And the thing about that is, if you are we talked about this yesterday. The two questions that I ask every buyer that's thinking about buying is, at the price point and the interest rate that a lender is quoting you, are you comfortable with that price? And if the answer is yes, like your monthly payment, if you're comfortable with that monthly payment, whatever that may be, get to a point to where you're comfortable. And then the second question is, are you comfortable, and are you kind of willing and able or plan to own the home for at least 4 to 5 years? And if the answer on both of those is yes, then you can feel good about buying, because the interest rate, if it goes up, well, then you have a lower rate than what the market is offering. And if it goes down, obviously it's got to move down more than just a little bit, but if it moves down significantly, then you could refinance and your payment's going to reduce. And if it stays the same, it stays the same. And that's what, that's why the first question is, are you comfortable with the payment? If it does not change and you can't refi to a lower amount, are you comfortable with that? And if that answer is yes, you can move on to the next one, which is, what's your ownership plan, like timeline? Are you going to own it 4 or 5 years? You protect yourself from, if we see a 5 or call it a 10% price decline over the next 12 months, but you own it for 4 or 5 years, we're now talking about 2025, 2026, 2027. Like once you get to that time frame, if we saw a 10% decline in 2023, you have 3 years, 4 more years for that price to move back up and get above where you purchased it, which is, if you look historically, when home prices drop, there is a rebound, and the longer the ownership period is, the better off you're going to be on recapturing that if you do time it poorly and you buy it and then prices drop. But timing the market is very difficult. It's almost impossible to do on purpose. So right. Buy when the factors make sense for you, which is, are you comfortable with your monthly payment, and do you plan to own it longer term? In a market that is, not as volatile as it is right now in terms of interest rates and just sentiment and the overall economy, that 4 to 5 window can be a little bit shorter. It can be, do you plan to own it for 3 years? And that's a healthy enough runway to kind of circumvent any issues. But right now we are extending that a little bit of, you certainly put yourself in a much better position if your plan is to own it for 5 years or more.
For sure. Another aspect of this question, I think there's kind of an underlying question here that Colby might be asking. Should I take my money out of Austin's market, hold that money, and then re-enter at another time?
That comes down to timing of the market.
Right. We don't want to time the market, but at the end of the day,
we just can't.
We don't want to rely on
time the market. But
we don't want to rely on trying to
time
it perfectly, because that's just a guessing game. We're not putting ourselves in a good position if we're trying to play that game, because we're going to miss it most of the time when we try to do that.
Yeah.
But long term, I want to be in Austin's market, and also long term, it's not going to be cheaper to get into a home in Austin, right? Like maybe in the next year, 6 months, it might be a little cheaper than it is today. I think it's probably going to be pretty much the same or slightly higher than where we're at today, but we'll see what happens in the months to come. Now there is opportunity to buy. There's more homes available, and we have a little bit more negotiating power on the buy side. And yes, the interest rate is a component of it, but if we're going to reinvest that money, we're going to put ourselves in a position where we're locking in that price, and then we give ourselves flexibility when it comes to refinancing if the prices go down, if interest rates go down. And then as we get more appreciation on that higher price point when we do the move up program, we're going to be getting a bigger return on our investment once prices do start to continue to tick up, where we see the, that 5 to 10% increase a year that I think is likely when interest rates start to come down eventually. Whenever that happens, I think we both believe that there's a whole bunch of pent up demand that isn't eliminated from this market. It's just waiting to figure out what interest rates are going to do. And once they start to tick down, it's going to be the same wave that we had earlier of buyers coming into the market. It's going to be competitive again, and it's going to be hard to get into a home. But now there are fewer buyers. We have strength in this market as a buyer and more options. So you just have to look at the whole picture, and if the timing makes sense for you to do it now's a good time to sell and buy and stay in Austin's market. I wouldn't want to take my money out of Austin's market long term, though.
Yeah, and right now, something that we have not been able to do the last few years is basically be a contingent buyer. You can put a property under contract to purchase, and that offer or that contract is contingent on you selling your home or the another property. So that was not existent before, because as a buyer, that wasn't a competitive offer. A seller would move on to the next one that wasn't contingent. But now sellers are willing to work with that. They're willing to put their house under contract on the contingent, that the buyer has to sell their property. And then you can kind of secure that thing, secure the property where you want to go at a price that you're comfortable with and all of that, and then list your home and get that sold. And so that's another option too, is you kind of know what you're getting into, where these last few years it's been really difficult, where a seller would almost have to sell first before they buy, which is very stressful, because they would sell, get a home under contract, and now they feel like they're under the gun. They got to find something. They got to win a multiple offer situation so they don't end up in, interim housing or something. So that is another thing that is easier for sellers to kind of navigate that move up, or even, that lateral move. But it allows us to kind of take our time, and we can kind of go through the process in a more normal pace than the crazy race that it was the last few years.
Yeah, without a doubt. All right, I think that wraps up all of our questions. Anything to add before we move on?
No, I think this was great. These are great questions. Keep them coming.
Awesome. Really appreciate you guys sending the questions. As always, we are here to help you achieve your wealth dreams through real estate. We both would love to help you out, so feel free to reach out to us. We have our contact information in the show notes. And also feel free to send us more questions. These were great today, and really enjoyed answering these questions. We'd love to answer more.
Thank you, guys. See you next time.
Awesome. Have a great day.